Good morning, everyone. My name is Nishlen Govender, and welcome to the second week of our CAM investment presentations. If you don't know me or haven't heard me present before, I am a portfolio manager in the Citadel asset management team, looking after strategies like 2020 and global greats, core parts of our house view, as well as just being responsible for the equity team and organizing and coordinating our equity team. So the presentation today will have a little bit of an equity tilt. And I think that is quite topical and important given the ructions in equity markets. So we will go through that. I'm going to share with you a presentation just now and also answer some of your questions. Some of you did have feedback from the last presentation, and we're happy to answer those questions. So if you have any more questions, feel free to send them through after this video, and we'll happily answer them in future videos. I have to say the significance of presenting to you over video and the monumental circumstances we find ourselves in are not lost on me. But hopefully this medium does satisfy us to a certain extent and allows you to get in touch with us and understand our thinking in a very difficult environment. So I'm going to share my presentation with you right now. It should pop up on your screen in a second. So I'm going to talk about three things in general: an update on COVID-19, a little bit on macroeconomics and the lack thereof in terms of data, and then an update on the equity market, my specific field. That is a summary of the talking points. And in terms of equity, I'm going to give you a little bit of a performance summary to give you a sense of what's happened in the equity markets, as well as to talk to you about valuations and give you a sense of what we're thinking in terms of where equities are right now relative to our assessment of fair value. A lot of strategists around the world have just taken away all guidance and assessment of markets just because of how volatile they have been and the lack of data. Us as asset allocators don't have that luxury. So we have to understand and conceptualize equity markets and the valuation of them along with the other asset classes. And I'll share with you our current thinking later on in the presentation. Before I get to any of that though, these were the three feedback points that we had from last week. Works quite nicely that I'm here because the first and last questions relate to equity, so I'll get into that. But let's start with the middle one. A recent article on Citadel Portfolio being able to implement structural changes. What is the view? We have a partnership with the company that effectively was in the presentation last week, the Paternoster Group. And we do political analysis alongside them. We focus more on the asset allocation and economic views. They have a political assessment. They've shared a document with our clients on where the current political climate is and where we could have opportunities in this environment. So please feel free to have a look at that. But a very short view is that we are hearing signs that we might be able to get some structural change based on how significantly this crisis impacted us. If you think of an SAA, for example, that was already in business rescue prior to COVID-19, the impact on South African Airways is even more intense now. If you consider a airline manufacturer like Boeing, that company is one amongst two in the world, Boeing and Airbus, and even that needed to be bailed out by the American government. So the ability now to push through those things, like potentially winding down South African Airways, does become something that we might be able to discuss. We've also seen areas like spectrum being released over the last week. And spectrum is effectively the ability for network providers to get more network bands and thus reach more clients. And ICASA, as well as the telecommunication companies, your MTN, Vodacom, Cell C, has been waiting for this for around 10 years now. So the fact that there's a release of spectrum is based on extra demand and the need for telecommunication services. So stories like that are positive. We're hearing about Citadel Portfolio starting a Vulindlela project where potentially he can get more of this done. And that would be promising if it's in areas, especially like public employment, with the wage freeze that has happened this year, potentially more to come. It could be good from a fiscal and budget perspective. But we're going to have to wait and see. We're saying that it could be potentially positive, but we're not sure just yet. We'll need actual actionable items to come out from it. In terms of SA equities, the first question, SA equities is always a tough one. You have to differentiate the market into three segments, and that is your Rand hedge stocks, so companies that get their revenues from outside of South Africa, your SA Inc. stocks, companies that are in South Africa, earning their revenues in South Africa, and then the mining companies, the conglomerate of those who might operate in South Africa but derive their revenues based on the dollar price of commodities. And if you then split the index in terms of companies that deliver or get their revenues from the rand versus offshore earnings, it's about 50-50. So the rand hedges and the mining companies sit on one side and SA Inc. on the other. So in understanding SA equities, you have to then make that split. And quite frankly, the SA Inc. component, those local companies that rely on the local economy, we still have a negative view on that. We expect dividends to be cut or at least delayed in a number of sectors, including banks and retailers. We think property companies will also be forced to cut dividends as force majeure conditions in their contracts force their rents to be non-payable. So we think that SA Inc. will still struggle. Unfortunately, we don't have fiscal and monetary levers to pull like other countries like the US. So we can't exactly help ourselves. We're still a little bit negative on the SA Inc. portion. In terms of the mining companies, they're a lot healthier than they were 10 years ago. So we're quite happy from a balance sheet and risk perspective. Demand is always an issue. So whether iron ore demand comes back as China comes back on stream is going to be important. Gold might be supported by the risk-on environment that we have now. And we're seeing platinum fluctuate depending on where the manufacturing production is coming back in Europe, especially from the car manufacturers. So we're seeing that playing out in different ways. And of course, oil has been impacted significantly from supply and demand side. So it's sort of net there. And on the rand hedge side, it has protected the economy quite well, especially as the rand blew through 19 rand to the dollar. So that has been helpful. The rand hedge component is also very different. You have companies like Naspers, British American Tobacco, and Richemont, all in different parts of the economy. So while Richemont might benefit from the rand weakening, it is also luxury demand, and that has fallen. So if you want to look at SA equities, you have to consider those three segments. So we want to still be underweight SA Inc. and overweight the rand hedges, as well as the mining stocks right now, because we do think there is going to be some demand that comes back. And I think the high quality of our mining companies helps us significantly. So positive around certain areas, negative on others. We still favor global equities relative to South African equities, but that dispersion has closed quite a bit in the sell-off. And then finally, the last question, discarded jewels. We've gotten this quite a bit, actually. And I push back on a question like this because I think the market is a very good discounting machine. And you have to consider what a discarded jewel is and whether it is still a jewel. A company like Sasol is a classic example. At 20 or 30 rand, was Sasol a discarded jewel? Some might argue yes, because it's now back to 60 or 70 rand, but we're well away from the 200, 350, 400 rand valuation that we had a year ago. The market is simply discounting current information. Quite frankly, Sasol has a lot to go through still. Possible asset sales, possible rights issue, being forced to deal with an environment where they are not the architects of their own demise, where the oil price will change because of OPEC plus and demand. It has little to do with Sasol themselves. With an oil price at $45, maybe they stave off a rights issue, but still need to sell non-core assets. And if the oil price fell down, which is our view because of a lack of demand, Sasol goes back easily to 20 rand and has to do a rights issue, etc., etc. So for me, it's not about fallen jewels. It's about understanding the risk that you're willing to take. We in the past have taken risks on a company like Aspen, for example, when it was trading at 60 rand. We thought that the market was incorrectly pricing in the threat of a rights issue, and we thought that with asset sales, Aspen could turn around. And it did. Our fair value was around 120 rand, and it got back up to 120 rand. So you buying what you think is a discarded jewel is you disagreeing with what the market is discounting in. And you'll see some of that a little bit later when I talk about the equity market and our current view. Odd to do these question and answers without some feedback, so please send us your feedback, send us more questions. We're happy to answer them in future videos. On to the actual presentation. I want to start with the COVID-19 update. It is the most important thing in our world at the moment. And we firstly look at the number of cases globally and how they're developing. And I'm just going to introduce a laser pointer here so I can track you along. These three lines represent COVID case infections in arguably what are the most important areas right now: the US, Italy, and China. As you can see, China's growth in infections flattened quite nicely. It was very important to China to do that. And Wuhan, for the first time, is now not under lockdown, and we are seeing movement in that area. On the other side, Italy and the US are now in their exponential growth phases, and we haven't seen that curtailing of infections as we have seen in China. The problem with graphs like this is that they are exponential. It's hard to see a trend. It's hard to see the turning point. So I'm going to show you a graph in a second that contextualizes where we are. This table in terms of growth numbers is updated as of this morning. We're now tracking these virtually daily to see what's happening. As you can see, we're on 1.4 million cases. South Africa's up to 1,700. Spain has surpassed Italy, and that's an important story I'll touch on towards the end of this section. And Italy now is starting to flatten, and you'll see why I say that in a second. This is the graph that we find much more important. This is for China, as referenced by the heading. It's again showing you the case development, that same line that you saw on the previous slide. So you see it exponentially growing and then flattening. These two lines that we introduced are super important for us. It's the daily change in the number of people infected. So every day, if 30 people are infected versus 20, 30 over 20 is effectively the daily change. And then we have a moving average, a 5-day moving average, to get a sense of a trend time. And what you see is, initially especially, the daily changes moves quickly above your moving average. And then it starts to fall below your moving average and slowly starts to curtail off as this graph starts to flatten. The nice thing about a slide like this, and the nice thing about looking at daily change, gives you a sense of when that inflection point is going to happen. And effectively, you're looking for two things. One, that the number of infection change day on day is moving below a moving average. That's crucial. The second thing that's important is the fact that your development of cases on a daily basis must fall below 10%. So your growth per day must slow to below 10%. As you can see, when China started to hit that region where growth was starting to slow below 10% and below the moving average, you started to see the inflection point. So it was a very good leading indicator of peak infection. And peak infection is what we are the most concerned about right now. It's exactly the same graph for Italy. And for Italy, you can see that you had exactly the same picture. You had this exponential growth happen initially that started to be reflected in numbers. It then started to slow below its moving average. So high was the exponential growth that it actually went above the moving average so far, I couldn't fit it into the graph. But now we are nicely below the moving average. And if I move myself out of the way, you can see that Italy very nicely goes below the moving average and then goes below 10%, and that's key. So even though you don't see it in this exponential path, we are starting to see peak infection in Italy. And if you've watched the markets over the last couple of days, 7% moved 2 days ago, or 2.5% moved yesterday, you're starting to see that the market is starting to identify peak infection, especially if they are important, like it. If you go over to the US, exactly the same thing. You have vast exponential growth for a long time, and only now you're getting that subtle move below the moving average and slowly to below 10%. We're not at that below 10% level yet, but we are getting there, which is crucially important, and that will signal peak infection, and that's what the market's discounting right now. So we'll get to it in a second, but a lot of people are talking about a bear market rally over the last couple of days where markets collapse, but they have a little bit of a rally. People think that's just a blip in the still storm. We'll discuss that in a second. Finally, from a COVID perspective, we know that the main issue has been around flattening the curve. That's why we've locked down economies largely. And this graph shows us why we do that. If you're in a spot where you're facing exponential growth, you do have the risk that your healthcare system takes capacity. So we've talked about the fact that economies are locking down, inhibiting demand, inhibiting economic growth, forcing us, quite frankly, into an economic recession. The fact is that this will allow us to avoid an even bigger crisis if the healthcare system gets overrun. Because like we saw in Italy, if your case infection rate grows too quickly, and if you don't have enough ICU beds or ventilators, the mortality rate increases significantly because people don't have the relevant resources to get better, especially with those that need critical care. So we are in the process of flattening the curve now. That doesn't mean we'll have no cases. So expect for when we leave lockdown for there to be somewhat of a second wave. But in the meantime, we're building better capacity. We're building immunity amongst people who've had the virus. We're getting the economy and the country used to social distancing where possible. And for the most part, it is working. And we do expect some form of recovery. I'll talk to you about that. That was our COVID-19 update. Like I said, it's something that we are tracking on a daily basis. The thing that we'd like to be tracking on a daily basis is a macro update and a macroeconomic view. The problem is macroeconomic data is exceptionally stale. If you look at a retail sales number, if you look at a PMI number, if you look for a GDP growth number, they're all quite old and they come out quite late. Where we do have economic data points, we are using them to understand the threat of the crisis. And this is an example of that for China. We have two lines on the slide. It's China's electricity production. So it shows you, in essence, demand in electricity. And remember, if your economy shuts down, your electricity demand goes down because factories are not working, you don't have industrial production, etc. It also shows you Chinese manufacturing PMI. Now, the PMI is effectively a survey that's done among supply chain managers. And what happens is, and you see on the left-hand axis, if the PMI number comes out above 50, then it means that that section of your economy is expanding. If it comes out below 50, it means that your economy is in contraction. Now, this is for manufacturing production specifically. So you see that China's had manufacturing production in expansion for a long time, brought down in the 2008-2009 financial crisis, and now in this COVID-19 crisis. In fact, the extent of it was so large that the PMI number actually dipped below the lowest point in 2008-2009. But the thing that we're looking for is some sort of recovery. Because we had this self-imposed restriction, we now expect for there to be some recovery as pent-up demand comes into the market. And we're talking about this idea of a U or a V-shaped recovery. You see the PMI number in China spike back up to above 50 very, very quickly. In fact, a lot quicker than it did in 2008, 2009. The extent of the recovery is something we're still trying to grapple with, but we do know that a recovery is coming. And I'll talk to you about that a little bit later, earnings perspective. As you can see, data points like electricity production, unfortunately, haven't caught up. So we're still trying to wade our way through information. Now, I have to say, the fastest economic data point you could find is US jobs data. If you get to the end of a month, the next Friday will give you jobs data in the US. It's by far the quickest economic data point you can get. And again, I'm going to move myself out the way just so that you can see where initial jobless claims were. Now, initial jobless claims at the bottom, it's effectively people applying for unemployment benefits. That has spiked now to 6.6 million people in America. Remember, that's a population of about 350 million. And non-farm payrolls, this is a sign of employment over a month. That has been positive for a record time since the financial crisis. That's now has slipped to minus 700,000, and the expectation was for it to be minus 100,000. So you can see how dramatic the effect has been in the US. And because we aren't at peak infection yet, we aren't seeing that turnaround. In fact, we're only seeing the first signs of the effect of the coronavirus. So we will wait for more data points there too. One thing that is skewing this number a little bit for the US is the fact that the US has significant unemployment benefits, not only pre-crisis, but also now in current crisis mode as they put through $2 trillion of fiscal stimulus. And that is allowing more people to be unemployed, which may sound bad, but it aids the social distancing campaign, which is good. So this is the state of employment right now. Unemployment's around 4.4 in America. The other issue that we have is the fact that economic data, because it's so old and because the outcome of the virus is so unknown, we have a vast degree of differentiation when it comes to economic estimates. On this slide, you're looking at the expectation for the second quarter growth in GDP from the US. So it's just one quarter, we're in it now, and this is the expectation from a host of different companies who all effectively use similar data produced by the US, but look at the range of data points that you get. Bloomberg Economics expects contraction of 10% Q2, whereas Capital Economics expects a contraction of 40%. We've never seen dispersion this large, not for a long time. So economic data points, because they are stale and because people are still grappling with the effect of the virus, we don't really have information available to correctly identify where economies should go. And that's the struggle right now. But again, we have to understand these to be able to allocate and find portfolios. What we can say, which is very supportive from a macroeconomic perspective, is that we are getting significant fiscal and monetary policy. And this graph tries to show you that. So in orange, you have the level of the S&P 500. In effect, the 500 largest companies in America. And then in black, you have the size of the Fed's balance sheet. Now, it's no surprise that these two move in tandem upwards post the financial crisis in 2008 and 2009, because interest rates were lowered down to zero, and the Fed started to buy bonds in the market, effectively pushing cash into the market, lowering yields, making equities attractive, providing liquidity. In that environment, rightly, equities were supported and were able to go up. And we are talking about very good companies in America. They did get that support. As the balance sheet started to unwind, as quantitative easing started to unwind, we started to see liquidity get taken away and the market started to have a little bit of volatility. But right now, and this last part of the graph is COVID-19 related, we are getting significant monetary policy from the Fed. And that is crucial in understanding where the market could go in its next leg. We're also getting record fiscal policy. We think about $2 trillion in the US, potentially another $1 trillion in the US. We're getting a stimulus in Japan, in parts of the EU, though they still need to come to terms with how and how much that stimulus is going to be. It can be very supportive of economies, of earnings, and of financial markets. And we're still trying to grapple and price this into, and the more stimulus you have, the more supportive of these financial markets. We've seen that in global markets over the last couple of years. Okay, so that is the economic update. Things are moving slowly from a data perspective, but we're getting information every single day. Now on to an equity update, and like I mentioned earlier, it is rightly the asset class that has been affected the most because it is companies, it is earnings that are going to be impacted by shutdowns and lockdown. And in this slide, I show you the difference in equity returns across different regions. I do it across a variety of different continents, across a variety of different markets, and over a couple of periods, 1 month, 3 months, and since the start of the year to date. And as you can see, you've had a very different equity environment across different regions. And that's important to understand because we're not dealing with a significantly irrational market where every single market sells off to exactly the same degree. We have a very good spread here of minus 11% for China all the way to minus 40% for Brazil. And if you think about economies that should struggle, export-rich economies, economies that trade, economies that rely on commodities, those should have been the ones to struggle first and the most. And you see it in the likes of Brazil, in the German complex, in Nigeria as an example from a commodity perspective, as well as India. And you see other markets that have higher quality that are able to protect themselves doing a little bit better, like the US with minus 17.5%. So a very large spread, but the absolute numbers are all terrifying. Minus 10 to minus 40 is still negative returns, significant negative returns. But if you start to dig into the underlying sector, and this is for the MSCI ACWI Index, effectively 2,000 companies from around the world, you start to see very differing returns based on the equity segment you're dealing with. So as you might imagine, healthcare companies are doing quite well. Consumer staple companies, companies that sell you essential goods and products, those are still doing reasonably well. Relative to your banks that are struggling in this environment, when loan growth is lower, when interest rates go lower and thus their margins go lower, industrials and real estate are also going to do well because you can't produce, you can't have rent. Consumer discretionary are your cyclical stocks. How many people are buying iPhones and iPads versus protecting their own incomes? Whereas on the other side, the service sector, where if you think about Microsoft or Google or SAL, SAP, those companies are still doing well because people generally still use their products and services. So you do get a good spread of returns in the underlying equity market, telling you that the market is capturing which sectors should do well or not. I dig even deeper to this and go sub-industry, and you see that now don't have a massive spread between minus 10 and minus 40. You have a minus 3 or minus 5 for sectors like healthcare technology, which makes complete sense in this environment, home entertainment, office services and supply, versus on the other side, companies and sectors that deal with trade, that deal with tourism, that deal with leisure or property, all struggling quite significantly. So when you have a very irrational market, you have every one of these sectors sell off dramatically and pretty much in exactly the same vein. In this market environment, the market is more correctly capturing the benefit of the doubt in which sectors should perform well and which shouldn't, which is important. From a different perspective, we have to look at equity market valuations. And this is where the story comes about of discarded market jewels. So is Apple a dripping roast right now? We would argue not. In January this year, this is exactly the same slide I presented to our advice team on Apple. And at that stage, Apple was trading at about $320. I had this table, which was the output from a valuation that our team did to show what our estimated fair value for Apple is and was in January. So this is pre-COVID, pre-coronavirus. They weren't even shut down Apple stores at that time. It was just based on underlying Apple. And the table tries to give you a spectrum of returns and says, look, we expect Apple's margins to be around 24%. We expect their revenue to grow by about 6% per year for the next few years. We then say, look, we could be wrong. So arguably Apple's margins could fall with higher competition, etc. Or they could go up to 26%. Unlikely as that is, because they are already trading like a luxury retailer in terms of operating margins. And maybe their revenue is able to grow to 9% organically. Which also seems unlikely, given the cost of iPhones, which are more than 60% of revenue, as well as how the global economy was starting to turn a little bit. In that environment where you had the maximum valuation, that puts you at $320 for Apple. And we thought that was an extremely low probability scenario, but the market did price it there. And we thought that Apple should be trading at $250 at that stage. If you think about where Apple's trading at now, just a couple of days ago, on Monday this week at the open, it was trading at $240, effectively in line with our fair value. Today it trades at about $270, so give or take in this range here. So even though we've had the proverbial bear market from top to bottom, companies, variety of them, especially the high quality ones, are still trading at what is a fair value, even pre-coronavirus. So don't think that a 30% sell-off implies that you will get a 30% return just because you buy these companies now. You have to really understand the underlying drivers and fundamentals and include the impact of the potential coronavirus. We do this now for every single company, of course. And we are picking up some value in certain areas, but it's not as rampant as you might think. When it comes to understanding the market at large, we have a problem when it comes to slow-moving data points, especially related to earnings. A lot of people are going to say to you at this point that equities are cheap. And they're going to say it's cheap because of graphs like this, where the black line represents the price of the market, and the orange line represents the earnings of the market. Now, as you can see, the price of the market is absolutely cratered. Quite rightly so, given the coronavirus impact. But earnings seem flat. The problem with a graph like this is when you draw a price to earnings number, you're putting in this price over that earnings, and arguably this earnings hasn't felt the full impact of the coronavirus yet. So what you have is a masked PE that starts to look too low, and that is a dangerous thing. Because if you start to buy a market thinking that it is cheap, if this earnings number creates 2, all of a sudden a price to earnings ratio rockets back up, and the market doesn't look that cheap. You see exactly the same thing in a graph like this, where you see the earnings yield. So what you get as a dollar of income from a company relative to the price that you pay in the orange line versus what you would get if you invest in a 10-year bond. So it's a yield versus a yield. It is comparable. As you might imagine, because prices have fallen so much, this earnings yield goes up quite a bit, just like a dividend yield. The problem is that, again, the earnings number in here is stale, whereas the bond yield is reflective of economic conditions. We go on dividends, it's even scarier because there are a lot of companies pushing off dividends and that might not pay dividends, and some of that's not captured yet. So a dividend yield might look artificially high, but it's capturing a previous dividend and is not correctly pricing in the potential or the probability that that dividend is not paid. So you need to be very careful when you think about equity valuations. Now, putting all that together, it meant that we needed to come up with a different way of understanding where equities should be right now. This is for the S&P 500, this table, and it's the way that we're understanding markets as well as companies in this coronavirus period. And what you're looking at is different levels for the S&P 500, given different market environments in terms of earnings and in terms of the recovery of earnings. Now, for context, the S&P 500 traded at about 3,300 points at its absolute peak. As you can see, this graph or this table doesn't have 3,300 points. It tops out at 2,900 points. So we're already saying that the market pre-coronavirus was trading at a level above its fair value. That was our underlying assumption. You then see a number of different levels on here. And again, for context, the market traded as low as 2,200 points, which is reflective of numbers in this part of the table, and is now trading at about 2,700 points, which is reflective of numbers in this part of the table. All of this is crucial, but let me tell you how it develops in the table. So we know that the coronavirus is going to impact operations this year in 2020. That is going to cause an earnings drop in this calendar year. This is what the horizontal axis is trying to show you. We are saying that there might be different levels for the earnings drop in this near-term year, 2020. What the left-hand axis is trying to tell you is that, yes, you might have an earnings drop in this calendar year, but you will get some of that back in terms of recovery from pent-up demand. But how much of it will you get? So if you lose 30% of earnings in 2020, do you get 100% of that back in the next few years? Do you get only half of that back in the next few years? Do you get none of that back? And if you have an assumption about the amount that earnings will fall in this calendar year, as well as about the recovery rate, it can tell you where equities are sitting. Now, if you go back to the global financial crisis, earnings fell about 35%. So that's a good ballast to try and use relative to this crisis. It's important that we started to use a valuation metric like this, because when the market sold down to about 2,200 points, it was reflective of an environment where the market was pricing in a 40 to 45% collapse in earnings, and then a recovery rate in those earnings in future years of only about 50 or 60%. In our view, that was overdone. And we believed at that stage that equities were undervalued and that we wanted to stay in global equities. And the effect and the impact of that has been significant, because if you consider a 500-point move from 2,200 points up to 2,700 points, we have gotten the benefit of that in our client portfolios and a little bit more based on the alpha that we received in our portfolios. Now, there are scary numbers on this chart down here in this sort of 1,400 to 1,800 level. We think that there will definitely be a recovery. It's only rational given that we forced ourselves to stop producing. So this bottom part of the table with recovery rates below 40%, we think is not reasonable, but we do put it in just to show the fullness of the numbers. So realistically, you're looking at an equity level from between 2,000 up to about 2,700. And you can see all the different assumptions you could make around that right now. We think an earnings recovery between 50 to 70% makes sense. We think that an earnings drop could realistically be anywhere, but from a probabilistic perspective, sits more towards the middle of this table rather than down towards the 50% earnings drop in this year. But it can happen given the extent of the virus as well as where we are now. So at around 2,500 points, we would think is pretty much fair value. So the index is a little bit rich right now at about 2,700, but it's not the market pricing things incorrectly. Remember, the market is trying to price in new data, and we are getting a lot of stimulus now, which is crucially important. Okay. To round up very quickly, I wanted to give you an update on some of our solutions, specifically 2020 and global rates, the mandates we're responsible for. On the Citadel 2020 mandate, it has been a rather painful period in the recent past. This orange graph shows you our rolling 12-month return. So every single point represents our current outperformance of our benchmark over the previous 1 year. And as you can see of late, there has been some underperformance in the mandate against the benchmark, which has been frustrating and has been led largely by resource companies, your platinum group metal. We've taken away a lot of risk from the mandate. We focused on high quality in the mandate. We missed significant market collapses like your Sasol's and your Capitec off late, which has been crucially important. And as you can see, this is now starting to turn the corner, and our relative returns are getting a lot better. If you look at our now 1 month, 3 month return, it is pulling up quite nicely. And that is pulling up the latter term numbers now. So we're effectively in line with our benchmark over the long term and over shorter periods of time, and that has been crucially important. Now, the absolute numbers are painful, and that is what you're going to get South African equities at right now, unfortunately. I want to show you our returns against some of the largest fund managers in the country. Now, I don't want to pick on any specific fund manager, so I named them fund manager 1 to 5 with us in the middle, and I want to contextualize two things. One, in the month of March, where we effectively had the bulk of this bear market crisis, the 2020 fund was down 10%, which isn't a great number. But if you look at other mandates in the country, which were down 18% and 23% and 21%, consider the fact that the negative 10% has protected you so significantly from losing double that in other mandates. And that has everything to do with our philosophy and process around high quality and good portfolio construction. This chart shows you all of those curves since inception of 2020, and ours is still on top. So against the largest fund managers in the country, we are doing very, very well. In terms of the Peregrine Global Greats Fund, that's the global fund, also a very difficult environment. You see the absolute numbers are quite poor versus our benchmark, but in absolute terms, we are ahead of our benchmark nicely by 2% relatively, and then by much more over longer term periods, which is crucial for us. But you see the extent of the loss down here at the bottom. Building alpha in this environment, outperforming our benchmark, is crucially important, but also being able to provide reasonable absolute returns is also something we consider. Why I think that this mandate is extremely important is the fact that the MSCI World Index is a developed market index, and the quality of companies in global greats is absolutely significant. I'll show you what I mean in a second. This is a chart that tries to differentiate between different equity segments. So here I try and show you in different levels companies with high net debt and low operating margins versus companies on the other side. So your level one companies are companies with low net debt, high operating margins in this environment, companies that can protect themselves. That is by far and away a global greats company. If you look at the return, peak to trough of those companies, they're in a region of around minus 16% versus companies that have significant debt, credit risk, and low margins who are down yet minus 31%. The companies you have in your global greats mandate skew towards the top. And you see that in the underlying returns from a mandate at around minus 10% rather than a minus 16% currently. From a market cap perspective, we also have the most highly liquid, highly tradable companies who have access to credit and who have access to equity markets significantly. And you see again the spread of returns where those companies have sold off a lot less than lower, smaller cap companies. So I think even though the absolute number looks bad, I think the relative number is a lot better than what you would have gotten if you invested in emerging markets, small caps, or marginal companies around the world. You aren't in global greats. Even in a black swan environment, our portfolio should hold up very, very nicely. And I think finally, from a global greats perspective and from a CAM perspective, our house view gives you a spread of global versus local. And if you consider that the Rand blew out to 19 Rand 40 and traded back to 18 Rand 60, the benefit of having a US dollar equity fund has been crucial. Because even though global greats is down 10% in a month, if you bring back the benefit of the Rand, global greats is up and up reasonably well. If you compare the performance of global greats in Rands versus the JSC, which is local equities, the result is absolutely significant and you don't see a bear market there. So correct asset allocation, correct currency exposure, having the correct mix of asset classes is crucially important. That is the complete makeup of our mandate from various perspectives. That is the end of my presentation. Thank you very much for watching. We'll hopefully see you next week. And as I said earlier, stay safe, stay healthy, and everything up to best. Thank you. Bye-bye.